In this video, we'll take a look at the economy, explore whether we might be in a bubble, and consider if history could be repeating itself. I'll also share my thoughts on what I plan to do if we truly are in a bubble. The major indexes continue to grind up despite increasing signs of trouble in the jobs and housing markets. Despite this, headline economic growth appears strong. Q2 GDP just got revised up again this week to a robust 3.8%. The Atlanta Fed's GDP Now just bumped its Q3 GDP growth up to 3.9% from its previous estimate of 3.3% as well. However, the economy and equities are primarily being driven by both large and unsustainable fiscal deficit spending and the massive explosion in tech spending on the AI revolution, including building scores of multi-billion-dollar AI data centers. Investors are increasingly starting to question whether these massive capital investments will pay off. The noted billionaire fund manager David Einhorn and the Wall Street Journal chiming in over the last week with the same concerns. The Harvard Business Review also just published a study raising doubts about whether AI will raise productivity in the workplace at all. The current market dynamics reminds us more and more of 1999 in the months leading up to the internet bust early in 2000. In this video, we'll highlight three key trends in the market that are eerily similar to the last innings of the internet boom back in 1999. This is probably the most obvious similarity between the two eras. The S&P 500 information technology sector forward price-to-sales ratio hit 8.8x this week. This is significantly above that of the tail end of the internet boom and the highest level ever recorded. The Shiller PE ratio is right near broaching the 40 level for only the second time in its history and slightly below the level reached last in 1999. Then we have the mother of all valuation metrics, showing how overbought the overall market has become. The market cap to GDP ratio is also known as the Buffett indicator. As can be seen above, we are in uncharted territory. Older investors may recall the huge growth in vendor financing, where vendors like Cisco Systems would book sales while providing financing on favorable terms to the customers purchasing its equipment. NVIDIA announced a letter of intent this week with OpenAI around a landmark agreement to deploy at least 10 gigawatts of NVIDIA systems for OpenAI's next-generation AI infrastructure. These facilities will be utilized to train and run its next generation of AI models on the path to deploying superintelligence. NVIDIA will invest up to $100 billion in OpenAI as the new NVIDIA systems are deployed. The first phase of this build-out is expected to come online in the second half of 2026. A CNBC article that came out around this deal on Wednesday succinctly captured the core themes of this investment, which appears to be vendor financing under a different guise, a rose by any other name, if you will. In May, Oracle committed $40 billion on NVIDIA's latest high-performance chips to power a huge new AI data center in Texas. Notably, this is part of the $500 billion Stargate effort. This massive initiative is led by OpenAI, SoftBank, Oracle, and Abu Dhabi's MGX. This consortium currently plans to invest up to $500 billion over 4 years. The primary goal of this initiative is to build a U.S. network of AI supercomputing centers. Back in late 1999, Microsoft was the most valuable stock in the equity universe, topping out around $600 billion of market capitalization. Impressive, for sure, but that was just over 1/3 of the annual GDP of France at the time. Just as now, the tail end of the internet boom resulted in a quite bifurcated market, with the top 10 stocks by market capitalization accounting for roughly 40% of the total value in the entire market. The only name that remains in the top 10 list from just over 25 years ago is Microsoft. TreeMap showing a breakdown of the 10 largest companies in the S&P 500 by market cap share, using data from Slickcharts and Mapsoi. However, now NVIDIA has a market cap of just over $4.3 trillion, which dwarfs the annual GDP of both the UK and France. Microsoft and Apple, both with approximate $3.8 trillion market caps, do the same. Alphabet sports a $3 trillion market cap. So, is it different this time? Let me just say first that the combination of FOMO, momentum, algorithmic trading programs, and passive index investing can keep the markets elevated for long stretches after equities have become detached from any sort of rational valuations. However, over time, the likely answer is no. It is not different this time for the equity market or investors. What's my plan if we really are in a bubble? I'll keep investing in businesses that act as compounding machines, ones unlikely to be disrupted by AI or caught in speculative manias. My focus will be on adding to my core positions and letting them compound steadily over the years. That's all for today. See you in the next one.